Australia's interest rate is now at the lowest levels ever. Let's have a look. Good morning, everyone. Florian Heiser here, and welcome to another episode of Heiser Says. I have my stein of coffee, and I thought today we would have a look at the interest rate cut from the RBA, because it is at historic lows. And we'd start with this announcement from Philip Lowe, the governor of the Reserve Bank, that he made to the dinner the day of the cut. So let's have a look at this. On behalf of the Reserve Bank Board, I would like to warmly welcome you to this community dinner. How would you get a ticket to that? Maybe this is how they do press releases. Damn, I should have stuck with economics, not architecture. Thank you for joining us this evening. We value this opportunity to hear firsthand from you about the challenges and opportunities you face. I would also like to take advantage of the timing of this dinner to explain today's decision on interest rates. I would be disappointed if they didn't organize all this stuff to just happen at the right time. You know, you'd hope they'd save money like that. As you would have already heard, earlier today, the Reserve Bank Board decided to lower the cash rate by 0.25 percentage point to 1.25%, so 1.25. This decision comes after more than 2.5 years in which we have held the cash rate steady. That last change was back in August 2016. At the core, today's decision was taken to support employment growth and to provide greater confidence that inflation will be consistent with the medium-term target. Now, inflation, as we all remember, the last quarter of March 2019 was zero. It was zero. Unemployment is trending up, as you can see here. So they're responding to the economy, obviously, but he goes on to say he's not. So I want to emphasize that the decision is not in response to a deterioration in our economic outlook since the previous update was published in early May. Okay, now that's a bit strange because he'll continue to go on here and discuss about how all their forecasts were wrong and how their expectations weren't met. So I don't know how's your impression to this? When I hear that interest rates are falling to the lowest level ever, my instant reaction is, oh, that's dangerous, that's bad. That we must be in dire straits if they're having to resort to that. Just emotionally, without any logic. And how do you think the average punter out there will feel? How do you think the average person hearing just the title in the news or hearing a snippet on the radio and they're going to work, they're going to tighten their belt. They will tighten their belt, and that will affect consumer spending and consumer confidence. That's just my theory, although I think it makes sense. And it's interesting how he's wording this statement, because you'll see the terms that he uses. The economic outlook remains reasonable. Okay? Who the hell uses the term reasonable? That's a really weak word. It remains reasonable. And you compare this to just how Trump would frame something. And a lot of it is to do with confidence in our leaders. But I really get the feeling the economy wasn't discussed much at all in this election, with the main downside risk being the international trade disputes, which have intensified recently. Now, this is an important thing to consider, and we'll have a look here at the Australian economy. Okay, and this is from the Observatory of Economic Complexity, and you can see this is our main trade partner here, where the largest amount of our exports are going to. And I'll link to this website. I've shown it a few times before. It's really useful. But just to get to an understanding, China is the biggest destination for our exports, 35%. All of Asia is too. So say China goes down with their dispute with the US, and US is 3.5% of our trade. Do you think China is going to impact all of these other countries? I bet you they would. There'll be a flow-on effect. So how do you think that's going to affect us when over a third of our trade or export trade is going to China? Just keep that in mind. It's definitely going to affect us. It definitely is. So that's the international trade disputes which he's talking about. The Australian economy is still expected to strengthen later this year, supported by low levels of interest rates, a pickup in growth in household disposable income, ongoing investment in infrastructure, and a brighter outlook for the resource sector. Okay, so the brighter outlook for the resource sector could all disappear because so much of our resource sector is dependent on China or our exports. And I will just scroll up here and you can see what we're exporting. 20% of our exports is iron ore. Another 19% is coal. And then petroleum. So what's that? That's, hang on. Sorry, it's moving around a bit. That's 20% plus 20% plus 8%. Nearly, 27% of our exports in natural resources, then crude petroleum, zinc. So all of this is natural resources. And even then gold you add on top of that. Okay? So all of this, and a third of it, 35%, I know, is going to China. So just something to keep in mind, keep in perspective where he's making these claims. Because they make all these claims here and these assumptions, and they can't even predict with any accuracy our inflation rate, or that it's not reaching the range that they're wanting to do. And previous articles, they're calling for state spending, state stimulus and infrastructure to kind of lift up some of these things. And they were even talking about quantitative easing, essentially printing money in a previous video I did about that. So let's keep going. It's just all, you need to keep all of these things in mind when you're reading something like this. And remember, the average person will just hear the snippet, and that will influence them more than you realize. So, back to the article. So today's decision does not reflect a weaker outlook. Rather, it reflects the fact that even with the expected pickup in growth, the Australian economy is likely to have spare capacity for a while yet. Spare capacity. Spare capacity. Have you ever heard anyone use that term, spare capacity? I would say underemployment, unemployment. But he's being very smart with how he's framing it. Because, I mean, he's not a politician. He's a bureaucrat. Today's easing of monetary policy will help us make further inroads into that spare capacity. It will assist with faster progress on reducing unemployment and will help achieve more assured progress towards the inflation target. So that is our rationale. What do you think, guys? Do you think it'll help that? I know that many of you are likely to have questions about today's decision. I would like to take this opportunity to provide answers to some of your probable questions. I'm also happy to answer your other questions after my prepared remarks. So I'd like to read through these prepared remarks because I think they really answer everything everyone wants to know. The 4 questions that I thought it would be useful to answer are as following. Why did the board act today after having held the cash rate steady for more than 2.5 years? Are there more interest rate reductions to come? Should today's reduction be fully passed on to mortgage rates? And what about savers? Has the board forgotten about them? So first, why move now after holding steady for so long? The answer is the accumulation of evidence. As you would expect, the board is constantly sifting through masses of data and seeking to understand what are often conflicting signals about the economy. As we've gone about the task over recent times, there has been a progressive accumulation of evidence supporting 2 conclusions. The first is that inflation pressures are subdued and they're likely to remain so. And the second and related conclusion is that there is still significant capacity in the Australian labour market. Now, to everyone who is an advocate of central planning economies, just look at how they are trying to manipulate our economy here, even for the better, and their lack of confidence. And it comes through in the wording of just what's happening. I feel they're quite reactionary, and I think the news, positive or negative, might spur on things. But then again, it's generally always going to be negative. When you get this low, it's going to be even more negative. When interest rates get higher, it's just going to be negative reaction all the time. The most recent batch of data has provided further evidence in support of both conclusions. The March quarter CPI was low, and it was below expectations. Well, yeah, 0 is low. So, in addition, the wage data for the March quarter confirmed that wage growth remains subdued, although it has picked up from a year ago. And the recent labour market reports also confirm that strong employment growth is not making up inroads into spare capacity in the labour market. Now, this is the thing, when they're talking about employment growth, are they talking about full-time jobs, real jobs, or gig economy jobs? The board judged that the accumulation of this further evidence meant that it was now appropriate to adjust monetary policy. Given the importance of these 2 conclusions, I would like to elaborate a little on them and explore their implications. The subdued inflation pressures reflect a number of factors. These include slow growth in wages, increased competition in retailing, definitely, the adjustment in the housing market with rents increasing at the slowest pace in decades, and various government initiatives to reduce the cost of living pressures on households. Okay, so if you want to reduce cost of living pressures, reduce power costs. If you want to do that, don't implement renewable power. It's that simple. As our chief scientist said, Alan Finkley, it's not going to make any difference what Australia does on a global scale. It's just going to increase our cost of living. And I would argue that if you have less disposable income, you are probably going to be in a more stressed situation, and there is a greater chance that you would cause additional pollution and damage to the environment. That's just a bit of theory crafting there. Just a bit of theory crafting. Let me know what you think in the comments about that. Collectively, these factors have contributed to delayed progress in returning inflation to the 2 to 3% target range. In underlying terms, inflation has now been below 2% for 3 years, and the latest reading was just 1.5%. So this is when they average it out. Looking forward, inflation is expected to increase, but it is unlikely to be comfortably within 2 to 3% range for some time yet. So the progress on returning inflation to target is more gradual than we had hoped. It is important to remember, though, that our inflation target is intentionally flexible, and that the Australian economy has benefited from this flexibility over the past 25 years. The board is aiming to ensure that Australia has an average inflation rate of between 2 and 3% over time. The focus is on the average and the medium term. Yeah. We've never sought to have inflation always between 2 and 3%. The RBA adopted flexible inflation targeting before other central banks, and this flexibility has served us well. It allows the board to set monetary policy so as best to achieve its broader objectives. Well, I'd argue it keeps the board out of doing too much, letting the economy run by itself and manipulating it too much, perhaps, that they're not overreacting to changes. That's just a guess. With the ultimate aim of contributing to the economic prosperity and welfare of the people of Australia. It has also allowed the board to look through temporary factors affecting inflation, which is what I said. So they're just letting the economy run its course. They're letting it go on autopilot. I don't know. I just think the more you try and influence an emergent outcome, the more damage you're going to cause, because a economy of a nation is a very complex emergent outcome. So there's more complexity in the overall organism, shall we say, of the economy than the individual parts that make it up. And if you're trying to influence one part of it, the ripple through effect can be hard to predict. So this flexibility, however, is not boundless. The point of our inflation target is to provide a strong medium-term anchor that helps deliver low and stable inflation, which in turn is an important precognition to sustainable growth in employment and incomes. If inflation stays too low for too long, it is possible that inflation expectations move lower, that Australians come to expect sub 2% inflation on an ongoing basis. If this were to happen, it would be harder to achieve the medium-term inflation goal, so we need to guard against this possibility. Moving on to our conclusions about spare capacity in the labour market. Okay, this will be interesting. For some years, most estimates of full employment, including our own, equate to an unemployment rate of around 5%. It was thought that if unemployment went below that for too long, inflation would rise and become a problem. But given the combination of the labour market and inflation outcomes we have seen of late, our judgment now is that we can do better than this. We can sustain an unemployment rate of 4 point something. I want to know the underemployment rate, not the unemployment rate. And the participation rate. It's also worth noting that the supply side of the labour market is turning out to be more flexible than we had earlier expected. The recent evidence is that when jobs are there, more people are joining the labour force, and other Australians stay in work longer. Reflecting this, the participation rate is currently at a record high. Oh, fantastic. Despite demographic shifts that we anticipated would reduce participation. Well, here you go. Here's another thing where they are planning, making assumptions about the economy and where it would tend, and where they've been wrong. Okay? Where they've been wrong. So guys, this is This is why I'm skeptical as well of all of the environmental modeling. The environment is an emergent outcome. It's a complex emergent outcome by interrelating factors that we can only measure certain parts in different areas over time. We can never get a full, accurate understanding of it. It's impossible without technology. Even the computer simulations can be manipulated. So people are making assumptions. So I would lean towards a more cautious approach than a interference approach. I'm generally more positive about these things. It is also the case that people are prepared to work extra hours. Men are prepared to work extra hours. Ba-bang! When there's strong demand for their labour. Together, these observations support the conclusion that there's still spare capacity in the labour market, and this is likely to remain the case for a while yet. The recent data has given us more confidence in this assessment, and we've responded to this. Over the past few years, one concern has been that lower interest rates could add to the medium-term risks facing the Australian economy as a result of high household debt. We need to keep a close eye on this, but this concern has reduced recently. Lending practices have been tightened considerably, and many lenders have become quite risk-averse. Well, yes, that's exactly true. The demand for credit has also slowed due to the changed dynamics of the housing market and slower income growth. So the risk on this front has been less than we previously thought. Okay, here is another example of where their assumptions and their modeling has proven incorrect. Where it's proven incorrect. I mean, because we've got here the banks are not to blame. Where can I find that article? Where with regards to changes to banks' risk modelling in Melbourne, their housing and property, people were buying land to develop a house on, but they couldn't get the financing, so the land had to go back on the market. It just comes to their risk profiles. Yes. So, this brings me to the second questions. Are interest rates going to reduce further? I think this is the one that everyone is interested in, isn't it? The answer here is the board has not made a decision, but it is not unreasonable to expect a lower cash rate. Well, it's because you're reacting to everything. You can't make a decision. You're getting everything wrong. You're getting all of your assumptions and modelling has been, is less than expected. We thought less people would participate in the economy, in the workforce. Am I the only one who's losing confidence in this, in their modelling, in their economic analysis? I actually did a bit of economics back in the day. It's interesting. I always thought it's funny they pretended they were actually like a hard science when they were not at all. You can only do so much statistical analysis on survey results. It doesn't turn qualitative data, response emotional data into quantitative data, into mathematical scientific data. It doesn't work like that. I'm sure you're pretending, but not really. Not really. And that's the whole thing as well with our dietary data. So our latest set of forecasts were prepared on the assumption that the cash rate would follow the path implied by market pricing, which was for the cash rate to be around 1% by the end of the year. There are, of course, a range of other possible scenarios, and much will depend on how the evidence evolves, especially on the labour market. If you accept the argument that a substantially lower rate of unemployment in Australia is achievable, the question that we should all be thinking is, how do we get there? Yeah, how do we get there? It's possible that the current policy setting will be enough, that we just need to be patient, but it's also possible that the current policy setting, will leave us short. Given this, the possibility of lower interest rates remains on the table. Monetary policy does have an important role to play, and we have the capacity to play that role if needed. I don't know. Do you think monetary policy has as big of a role to play as people are realizing? This seems in stark contrast to what was being said in another article. In saying that, I would also recognize that monetary policy is not the only option. Oh, well, there you go. He's just, what are you saying? There are certain downsides from relying just on monetary policy. There are limitations on what realistically can be achieved. So as a country, we should be looking at other options to reduce unemployment. Well, yes. Yeah. One option is for fiscal support, including through spending on infrastructure. I would not have a problem with this if it is dams and nuclear power. Dams and nuclear power, not roads, dams and nuclear power, not moving shit around, infrastructure that is actually going to affect day-to-day people's lives. Dams, food production goes down. Cheaper. More food production, more export. Nuclear power production goes down. Cost of everything manufactured in this country goes down. 2 ideas right there. This spending not only adds to the demand in the economy, but also adds to the economy's productive capacity. So it works on both supply and demand, or demand and supply. I'm always used to reading supply and demand. Too much economics. Another option is structural policies that support firms expanding, investing, innovating, and employing people. Well, getting rid of red tape, maybe. How about we get rid of payroll tax? All 3 options are worth thinking about. From my perspective, the best option is the third one, structural policies that support firms expanding, investing, innovating, and employing people. Well, that sounds good, but is we just avoided a Labour government that I would argue had an element of sovereign risk to it. A strong, dynamic business sector is the best way of creating jobs. Structural policies not only help with job creation. Well, no, they don't. Okay, they don't help with job creation. I don't agree with that. They free up business capital to allow for job creation. Anything the government implements, any policies or procedures, anything, any bit of legislation, I would argue, decreases jobs to one level or another. You're getting a deadweight loss. So the more control you influence on the economy, the less employment opportunities there are. Even a minimum wage. That prices certain people out of the market. Right there. You may not agree with it, but that's the truth. That's why in economics you will have a minimum level of unemployment they expect you to always have. Anyway, back to this. But they can also help drive the productive growth that is the main source of improving our living standards. Well, see, that goes in contrast to everything Greens and Labour are putting forward. Why do we have one of the major political parties here in Australia trying to remove a part of our economy, which is, 20% of our exports? Yeah. Sorry, 19% of our exports. I'll say coal isn't the future of Australia, 19%. Crazy. So, I will now change tact and move to the third question. Should today's reduction in the cash rate be fully passed through to mortgage rates? Okay, pardon me. My usual practice in answering this question has been to explain that there are a range of other factors that influence mortgage pricing. I'm getting tired, guys. And then say it all depends. Oh, great. Wishy-washy answer. Would that inspire you hearing this speech, at a political rally? Would it inspire you? It doesn't inspire me. There are often reasonable explanations for why standard variable mortgage rates does not move in lockstep with the cash rate. Today, though, I would like to break with my usual practice and provide a clear answer. And that is, yes, the reduction in the cash rate should be fully passed through to variable mortgage rates. The answer is based on recent reductions in banking funding costs. Not only have the costs declined as a result of the change in monetary policy, but they've also declined because of movements in market-based spreads. Last year, these spreads increased, and most leaders responded by increasing their standard variable rates by around 15 points. Over recent months, these spreads have reversed. All the increases that have occurred last year have returned to 2017 levels. The result is there's been substantial reduction at both the short end and long end in the cost of banks raising funds in the wholesale market. Average rates on retail deposits have also come down. This means that the lower cash rate should be fully passed through into standard variable mortgage rates. Full pass-through would also mean the economy receives the full benefit of today's policy decision. And this brings me to the final question. What about savers? Have we forgotten about them? Bloody oath. I know this question is on the minds of a lot of Australians, especially older Australians. I'm reminded of this daily as people write to me telling me how their already low deposit rates are affecting their income. I'm expected to receive more such letters and emails after today's decision. The board had a thorough discussion of this issue at our meeting today. We recognise that many Australians have saved hard and rely on interest from term deposits to support their income and spending. Today's decision will reduce their income from this source, and we understand why they would be disappointed with the outcome of today's meeting. At the same time as paying close attention to this issue, the board considers what was best for the overall economy. Our judgment is that lower interest rates will help the economy as a whole. At the moment, this benefit is likely to come mainly through two channels. The first is a lower value of the exchange rate than would otherwise have been the case. The second is a boost to the disposable income of the household sector. In aggregate, the household sector pays around $2 in interest for every dollar it receives in interest income. So in aggregate, lower interest rates reduce the net interest payment of the household sector and so boost overall disposable income. Well, yes, that's only if you're in debt. That's only if you've got a variable rate mortgage. It's not going to be passed on to every forms of interest, is it? So I guess it's going to help people that probably don't have savings. In turn, we would expect the lower exchange rate and the boost in disposable income to lead to more jobs. The lower exchange rate, where's that come from? You haven't mentioned that before. I guess, well, it's going to lower because the incentives for people to invest in Australia is going to be less with regard to your monetary interest rates. Lower unemployment and a stronger economy. I don't know. This should benefit us all, although I recognize that in the short run, the effects are felt unnecessarily even across the economy. It is partly because of this unevenness that I want to repeat my point I made in answering the second question, and that is the best approach to delivering lower unemployment and a stronger economy is through structured policies that support firms expanding, investing, innovating, and employing people. Well, see, this, I would say, reducing policy, limiting the amount of paperwork businesses have to do. You know, doing your best every bloody time, collecting this, collecting that, red tape here, there, everywhere. How many businesses are offshoring their work because it's a pain in the ass to employ people here? Let me know in the comments if you have done it. These policies can have distributional effects too, but the benefits are more broadly based. So as I say, as we ease monetary policy, it is the country's interests that other policy options are considered too. This brings me to the end of my 4 questions and answers. I hope this has helped you understand the board's thinking and why we took today's decision. I'm happy to answer other questions that you might have. Thank you for listening and joining us this evening. Well, guys, what do you think about that? What do you think about that? You know, it's not really filling me with confidence, particularly all of their assumptions that have had to change. It doesn't surprise me. Is this going to affect you? You know, I will look at some other who will get the best rates and the winners of losers in other videos I'll release today. But I thought it was important to just go through his announcement here. You know, good on you, Philip. Thank you for putting it through. I know a lot of people would probably never read this in its entirety, so I thought, why not do a video on it, guys? Let me know what you think. You know, use my hashtag. Are you keen on it? Are you not? Do you think this will have a benefit to people in the economy, or are you a bit concerned about all their assumptions they're getting wrong? What does that tell you? Anyway, guys, please like, share, and subscribe. Ding the bell to see my daily updates, and I'll see you all again tomorrow. Bye for now.